Welcome to the podcast where we discuss all matters financial planning and investing. This content contains general information only and may not be relevant to everyone. Please contact our office to make sure and determine if this is relevant for you. Hi and welcome to the podcast. I'm David Lockton and I'm joined with my co-host Cole Eccles. How are you, Cole?
Good yourself, Dave.
Good. Today we're talking about really one of those topics that people talk about a lot, and probably their number one inquiry we get is like how to really legally pay a little bit more tax.
That's right. Yeah. Everyone hates paying tax.
Everyone hates paying. I always find everyone hates paying tax, but their real problem is they probably don't have a strategy to build their wealth. I find tax is a really important part of the overall strategy and structures and so forth. And even for myself, I look at it many times. Being a business owner, there's a lot of different things we can do, or how do you build that out to actually get the best results? And the ATO seems to make it harder every year to actually save tax. Yes, I think accountants eventually, just generally for people who are employed, will be out the door eventually.
There's not much you can do. Yeah.
There's not much you can claim, or everything you can claim, the ATO come down, and with the government getting re-elected, they're on the spending spree.
Got to recoup it.
They've got to recoup it, and generally it's going to come from us the taxes and all the people who are working and all those sorts of things.
The positive side of the spin, though, is like if you're paying tax, at least you're making money. You'd rather not be paying tax.
My dad, back in the old days, my dad used to say, "Oh, I don't pay much tax," and I'm like, I thought that was a good thing.
Yeah.
But I'm like, you're not making any money. Yeah. And even business owners, when a lot of people complain about, business owners don't pay that much tax. Company tax rates minimum 25%, goes higher up for bigger businesses. But they are getting taxed somewhere. And at the end of the day, getting money out, and the government's making it hard, especially like even on professional service firms, have to take so much of the profit. They can't use some things we'll talk about a bit later, trusts and bucket companies and so forth. You can only get rid of so much money. They want you to be paying so much amount of tax, or they're saying that you're not avoiding tax, you're tax avoidance. And they're going to come after you. It's like a really tricky fine line. But if you're salary and wages and earning over sort of 190 grand, you're up in the 47% tax rate. A lot of business owners can actually keep that around 30. So that's why lower. But if you're paying any lower than tax rate of 30% and you're in professional services, you're in trouble from the ATO. You got to watch out what you can do. But for most people we deal with, most people are, I would say 70% of our clients are just regular working employees. And, there's some of the things that they can do. I think probably superannuation is one of their main ones.
That's probably the main one. Yep. And there's various ways you can get money into super. Obviously, we touched on the previous podcast, but in terms of reducing your tax, obviously you want to do it on a pre-tax basis. So the big one is leading up to 30 June we touched on that in our podcast about the episode about super contributions, is that the catch-up contributions, or the ones where you haven't used. So they're allowed to put up to $30,000 between yourself and your employer on a pre-tax basis. And if you haven't used up that's called the concessional cap, if you haven't availed of that cap over the last 5 years fully, then you can do that now. It carries over 5 years if you're balanced under 500,000 with super balance. So that's a big one. Leading up to 30 June, it gives a nice kick to your boost, boost to your super, plus save you some tax.
Yeah, I think a lot of people actually forget through the year to do it. Or I was going to put more into my super, but 30 June, it's over and done with. It's one of those things when you're adding money to super, you are making a sacrifice. So you are taking some money out of your pocket. As such, but on a tax basis, not fully, depending on what rate of tax you're paying. Contributions going to super are generally taxed at 15%, and generally employers are paying 32%, pretty much minimum for most people, and then beyond that. So some people think, it's not a big saving, but it's twofold in that with super, you're saving some tax, but also that money is going to be working for you for the next 30, 40 years. Do you know what I mean? So I think those catch-up contributions, the government co-contributions, just super in general, I find if people haven't got a plan or to maximize their super, probably missing out over a long period of time. And we were just chatting about it before with government's new tax on investments over 3 million that may or may not go through. Kids that if they're in their 20s putting or on their just normal wages going in the super, they'll have over 3 million in super. That's incredible.
AB done modelling, and that's based on not high income earners. The average income today indexed at 3% per annum over the next 35 years. I say you'll accumulate over $3 million. Or if you put more into super, or depending on how investments perform, etc. So yeah, that's, everyone's gonna be a millionaire soon. So
I think a millionaire back in the day into a millionaire today is a difference.
Yeah.
It's like not a multi-millionaire now.
Yeah,
It's
that's
probably
right.
similar.
Yeah.
And just, I think that the overarching thing is because for a lot of people, super's a long way away. Even if you're still in your 40s, even or early 50s, you feel like 60 is still, or when I can access my super or I'll live forever. But yeah, I can assure you with our clients, once you get over 60, it's like, it's not the same. Everyone says to me when they've done a plan, and especially around super, oh shit, I wish I'd done this 10 years ago or 15 years ago. Because like if you're in your early 40s, for argument's sake, or even younger, and you start maxing out your super on a yearly basis, and especially a lot of couples, probably a lot of our clients are couples as well. And if a couple's doing that, it ends up to be extraordinary amount of money. Everyone says, oh, I need to do all these risky things for argument's sake to become a millionaire. Actually, you don't.
Then on the flip side, you've seen some, just recently, there's a couple of clients where their parents had drilled into them from a young age how important it was, and they started young in their early teens, or some of them when they just first started working. And you look at them where their super balance is now compared to someone who's taken on a keen interest later in life. It's quite massive.
Yeah, like just one guy comes to mind. They've got over $1 million in their super already between them, husband and wife. And I think he's only around 35, 36. They're super. I said, like, one thing we don't have to do is mess with your superannuation, right? It's like, you don't even need to put any more in. I think theirs is on track for over $4 million or something like that. So yeah, the earlier you start, the better. And from a tax perspective, it's one of those things, like generally if you put money in a super, you won't miss it. Do you know what I mean? You generally get, most people actually don't know what they spend every day or every week or every month or whatever. And it's very rare we run into someone who knows where their money's going. So you're utilizing your super. What about all the everyday, the tax things that people can claim?
Yeah, I think there's on the ATO's website, obviously this time of year, you always get news articles, etc. And so I think on the ATO's website, there's a guide to what they think is reasonable deductions for trades or occupations, etc. So you want to make sure that you're claiming what you're entitled to, but no more. Obviously, I read something the other day. I don't know, I was reading what it was about, some of the things they'd read and some of the claims that ATO had denied, and this is from the ATO. And with some outrageous things like for a mechanic claiming all sorts of stuff, and it just doesn't fly. So something that you're entitled to. So if you wear a uniform to work, obviously entitled to laundry, outdoors, sunscreen, protective wear, etc. So making sure that you claim what you're entitled to.
Yeah, what you're entitled to. And there's a whole, most people don't keep receipts. So keeping receipts and all those sorts of things are important, and just understanding what you can claim. It's a little bit of pre-planning, you know what I mean? Anything you upskilling yourself and all those sorts of things. If you do have properties, deductions in there, if you do give money to charities and so forth, things to there. So there's just the regular things, because I think in a fast-paced world, we just miss stuff.
Yeah.
And if you just, I think, diligent through the year, you'll be able to make sure you max out. I know the difference is just speaking to different people. Some people claim everything. And then some people claim nothing.
Yes, the property one as well is important. I had a client before that sold a property, and throughout the time that she held that property, I think it was over 10 years, she never claimed depreciation because she didn't know about it. So people just think, obviously, the obvious ones you're paying out of your pocket, like the interest, the bills, utilities, etc. But depreciation sometimes is one of the bigger deductions, and people sometimes miss it. So
having a depreciation schedule. So working with your accountant, especially if you're a property investor, I think a lot of people are do it yourself these days. Like I know people say, what am I going to pay an accountant for? That's where it can be dangerous. So it's not a bad investment. It's tax deductible.
And just going back on the super one as well, because come across later as well. So someone is putting money into super potentially on an after-tax basis, just having a look at the end of the year, understanding or close to the end of the financial year is what their tax position be like, because maybe it might be beneficial for them to claim some of that as a tax deduction. So just speaking to their advisor or speaking to their accountant to be aware of what they may or may not be entitled to, what they may, should or should not claim.
Yeah, well, we find that as probably in healthcare professionals, they do a lot of that 5% post-tax really contribution, and then they potentially could claim it. But they think they need to do that so the government give them the extra money. But they don't need to anymore. It's just part of the scenario is what they do. So, cool. So the investment property is one of those big ones. So people, if the properties are negatively geared, so obviously if that's costing them more than money's coming in, the tax deductions around there, the depreciation schedules, and anything that they've had to swing the property up to speed and all those sorts of things. It's one of those things, probably in all the plans we do with our property investors, and I would say like a quarter of our clients would have investment properties. is keeping really up-to-date track records of how they go and just really understanding what they cost. It's like when you're weighing up to actually buy an investment property.
Yeah.
What are those expenses and so forth? What does the property need to do to even just break even,
Yeah.
let alone make me some money?
Yeah.
So it's not, there's a lot of people out there that think property is the only thing. It can work and it can go backwards as well.
That's right.
There's two sides of that. And we've got, so really, I think when it comes to tax, so sort of pre-planning, it's how you invest your money is really important. And there's many ways that can potentially happen. But one of the things we do a lot with our clients is called debt recycling. How does that sort of help in a tax perspective?
How many times do we come across a client who holds investments in their personal name and they've got a mortgage or a home loan, but they've used cash to purchase those investments? So debt recycling is basically, you don't necessarily, a level of debt doesn't necessarily change, but you're converting what's non-deductible to deductible debt. Debt recycling is basically we're taking extra money, instead of just paying it off your home loan, we then putting it onto your home loan and then pulling it back out and investing it. And so suddenly that money that you've now invested, that portion of it is now tax deductible. Like you said at the beginning, the tax office always wants to get their at the ticket. So if you investing in something that's going to generate income or gains or some taxable impost down the track, then you can claim the interest on that debt as a tax deduction. So it's basically, you're trying to do two, you're trying to build an investment and reduce your non-deductible debt at the same time. And the idea is that obviously by the time you sell your investment, that the profit you make on that is going to be more than, and the cost to hold that debt is going to be less than the profit you're making over time.
I mean, one of those strategies that most people don't know about, unfortunately, a lot of accountants don't advise their clients. Well, they don't know what their clients are doing anyway. So if they haven't, probably the negative, if they haven't used debt recycling and they've bought some shares for argument's sake, any income coming from those shares generally go on their taxable income and they've got no offset. So they'll pay tax on that income. If they obviously borrowed the money to do that, they've got the offset of the home loan, which is generally more than the interest rate at the moment. So there'd be no tax to pay on that income. So that's the biggest probably difference. But also what I find is a lot of people don't want to wait till they've paid their home loan off before they start investing. Right? If you want to start investing while you still have a home loan, if you're not using debt recycling, you could be costing yourself a fortune. That is the bottom line. Over a long time, look, if you're going to build out a $500,000 investment or $1 million investment, and you're not doing it structurally sound, there can be a lot of problems with that. So that comes into probably two other things around the investment structures. There's a lot of our clients and a lot of people out there invest through what's called bucket companies. And one of the sort of advantages of bucket companies, it's really only an advantage to people on high incomes or so. So generally an investment company or a bucket company pays 30% tax on the money that it generates. But if you're a high income earner and you might be paying 39% tax or 47% tax on investment income, especially the 47% one, a bucket company can make you keep 17% more of the money rather than paying to the ATO. And over a period of time, that becomes a lot of money. And also even the tax you pay in a bucket company becomes franking credits. So if you're looking to draw the money out over time, you can actually start getting money back from the ATO. They actually the ATO years ago tried to stop that from happening. Stop trying to give people money back, but especially retirees are like, no way, mate. You're not doing that or you'll lose government. So that's a really interesting part. So tax paid, depending on down the track when you take it out, you may be entitled for the ATO to give you some money back. It also becomes a credit if you're taking a lot more money out, and then sometimes you don't, but then you don't have to pay any further tax as well. So bucket companies for a lot of people can be a really good vehicle. It's not for everyone, depending on your situation. Generally, in that there's trusts hooked up to it. So a lot of people invest through a trust, and then the leftover money from a trust has to be distributed every year. And instead of really distributing that money back to the individual where they pay the highest tax rate, they actually distribute it to the company, and the company can pay a lower tax rate, and then it just can keep investing. That's if it's money that you don't need over a long period of time. And that works in certain scenarios. You've got bucket companies, trusts, and then you're probably one of the ones that 30% of our clients or business owners that they can invest in different ways. And that's through investing through their business, where building out a business or building out an asset. One of the really cool things about building an asset, especially if you build it out to millions of dollars over time, is that you can sell it generally, for most people, they'll meet small business concessions and superannuation concessions. Really, if they build up a $2 million asset, they potentially could sell the whole thing down the track and pay no tax.
Yeah.
And that's, instead of paying personal tax as you go, just keep investing in your business. It's a long-term strategy. It doesn't always work out. Like, business can be one of the riskiest things to do. Investing in your business can really ramp up those things to really get the money working. And there's different structures, even around business, with holding companies and so forth, where there's a lot of people we run into have a company or a business and the owner is them, unfortunately, where, if it was a trust or if it was another holding company, the money can be kept in that environment and invested
at
a lower tax rate. So, however it's like running into so many people, the business was set up originally just because we're trying to be cheap and get enough, we're going to make any money, all those sorts of things, but they can be reset up. That's what we do with some clients, depending on the scenario, to really help them pay out home loans and pull out some money out of the business without actually selling the business. So they actually sell the business to themselves so they can get some money out of the business and hopefully knock out the home loan. Also invest from that business at the lowest tax rate. Companies, depending on their scenario, a lot of the time, the trust bucket company scenario, they're paying sort of 30% tax in that scenario, the bucket company. But if it's a holding company, generally, if that's getting 80% of its money from active assets, it can actually be paying 25% tax, so keeping a lot more. So between 25 or 47% tax, which one do you want to pay?
Exactly.
And that's also building it out. So depending on your needs, so if you need money to pay your home loan off, you need more money to live, and everyone needs the basic needs. But I'm talking about money after that. So from a tax perspective, there's a lot of people who are in positions where they could take advantage of some of the things we're talking about today. And we're only touching on them lightly, so they definitely go and speak to your accountant, speak to your financial advisor who knows tax financial planning really well, because these things potentially can really make you a lot of money, save you a lot of money, and everything in between. So what are the biggest mistakes most people make when it comes to tax?
It's like record keeping, like you said, you spoke about making sure that you know what you're entitled to, and obviously keeping accurate records, because you don't want to be entitled to a deduction, but you can't prove it. So it's keeping records, and not like now it's middle of May at the moment. So you should start planning now. Don't leave it too late. Speak to your accountant, speak to your advisor. You don't. And obviously if you're looking to take advantage of super contributions, it's got to be in by 30 June. So you can't leave it too late, because everyone's trying to get money into super in June, and then you don't want to miss out.
And when you're putting money in the super, depending on how the money's going in, if it's going through employers, it can take a couple of weeks to get in there, and that becomes a problem if you do it late. If all of a sudden it gets into the following financial year, that becomes the biggest problem there. But what I find as well, so the biggest mistake most people make is not planning for it. And it's one of the things I consistently look at for myself, for our clients. It's like, where are they financially? What are the opportunities that they do have? Planning personally, investing, and overall. And it's just amazing when I show people, especially with all the new plans that we do, just showing people how much they save, but also how much they can build their wealth up by being smart about tax. So it's not about paying no tax. Look, at the end of the day, if you're paying no tax, you're not earning any money. That's the reality. We want to limit it, but we really want to build our wealth. And I think touching on from using your super, making sure you keep all your records, and making sure the way you invest is the most tax effective. You're never not going to avoid it completely. And also tax effective for now, but also I think in the future as well. Like if you're looking to build out your wealth, it's not a one-day thing. All the zillionaires that we run into happened over 20 or 30 years. It didn't happen over 1 or 2 years. Like, sure, that happens. I've just never seen it. Like, I haven't met anyone who once had Slotto or that have like 25 and made $1 billion from whatever they've invented. There's a few people out there who've done that, but generally most people over a lifetime can make a hell of a lot of money if they're effective with their investing. They're effective, but and tax is a part of that. And I think a lot of that we've touched on today, which I think they're all really incredibly important areas. If you're looking to build your wealth, you want to be taking advantage of them.
I think the key is all you said. You just touched on it about reducing tax, but using that wisely, like building assets. Like you see people all the time. I can speak to friends of mine. It's like, I'm going to buy a car because there's a tax or depreciating asset. Is like, yes, you're going to save tax, but that's going to cost you a lot. You know what I mean?
It's a liability.
So it's about saving tax, but also on the flip side, it's trying to doing it wisely, using that money wisely.
Yeah, absolutely. It's like, it's no use trying to save some money or save some tax, and then increasing your lifestyle immediately. So it's like, it's got to be a benefit in both things. And I find, end of the day, we are in a consumable world.
Yeah.
Like it's like, look, how many things do we have? We have Netflix, we have maybe one other thing, and then like I look at me, like got Spotify as well for the family, and then you've got all this other. It just goes on and on. I was talking at last night. It was Mother's Day yesterday, and we are just talking about. We just got back from Bali. We had a trip in Bali, and just how they live compared to how we live. It's like just different worlds. And most people need to meet the first two basic needs, which everyone in Australia, well, not everyone, most people meet those, which is a roof over their head and food. Majority of people do have that. And the way Australia runs is pretty accommodating. But then it's just amazing the different lifestyles out there, and what we've really got to be thankful for a lot that actually goes on here in Australia compared to the rest of the world. But why not use the tax system to your advantage?
And some of our that you talk about that we're fortunate to have is funded through the tax system, so you got to pay some tax, really.
Yeah, like it's like, why don't you go? Like, people do go live in Bali for argument's sake, right? They're like, Australia is too expensive. A lot of people, but the reality is, every time I come back to Australia, I feel we live in the greatest country, or I would live somewhere else.
Yeah, that's right.
We have the opportunity to live somewhere else. So as much as we complain about tax, it is there to service all the things that Australians are entitled to and what we get. Even though I don't agree with half of what they do. That's another subject. But anyway, thanks for your time today, Cole, and thanks for watching. If you need any help, please feel free to book a call with us. And also, if you like this podcast, please share it with your friends to help us build it. Thanks for watching, and talk soon.